Hello everyone, welcome to our webinar. I'm Diane Della, Senior Tax Manager in the consulting team for Tax Assist, and I'm joined today by my colleague Victoria Seeley, who is a tax manager with our technical team. You'll know, I think, that we have around 80,000 clients all across the country. The consulting team deals with potentially all of those practices. Obviously, I couldn't possibly talk to all of you, that would be a Herculean task, but most of you, but many people won't need consulting services on a regular basis, but because we see things collectively, as it were, for the whole of the network, then we tend to see repeats of things that may come up once or twice only, almost in a lifetime within each of those individual offices. So it helps to have us here because we just have a bulk of experience that just from bulk of numbers really that match some matters we see. So we have the facility to ask questions. There's a Q&A facility on the screens. We will come to any questions at the end if we have time. If we don't have time, then we will come back to you in writing after the webinar has finished. I've been a bit slow clicking the buttons here. Here's our disclaimer and the things we're going to cover today. The first couple of items Victoria is going to deal with. Her speciality is more personal tax, whereas I tend to be more focused on the corporate side of things. Obviously, there is an overlap for businesses where you might move from unincorporated into companies, so a lot of this stuff crosses both sides of that. But Victoria will deal with paying tax at the right rate and tax-efficient investments. I will then deal with tax planning for the self-employed, and then we switch around a bit towards the end. Okay, Victoria, so if you're ready, we'll move on to this first section, paying tax at the right rate.
Thanks, Diane. So firstly, I'm going to talk about the different income tax rates in the UK and Scotland, some different reliefs and allowances for an individual to make use of, followed by some tax planning ideas just to help those save income tax. So first of all, looking at the 2021-22 income tax rates, all individuals are entitled to a personal allowance of £12,570. So that is taxable income, which attracts a 0% tax rate. Then followed by the basic rate band, which is where you are subject to income tax at 20% on £37,700. The next tax band is the higher rate band, which is taxed at 40% on income between £50,271 and £150,000. And then the final tax rate is 45% on additional rate income above £150,000. Now, this is applicable on non-savings income. There will be different UK rates on dividends and saving income. There are different income tax rates if you live in Scotland, so please be aware of this. Just some term tax allowances and reliefs for those to be aware of. Each individual is entitled to a dividend allowance of £2,000. This is where the first £2,000 worth of dividend income is taxable at 0%. And this is not tapered depending on the level of taxable income you receive. Moving on to the savings allowance, depending on your level of taxable income, if you're a basic rate taxpayer, you will be taxed at 0% on the first £1,000 of income. If you're a higher rate taxpayer, you will receive £500 allowance, and this will be completely tapered to nil if you're an additional rate taxpayer. Moving on to the marriage allowance. Now, this is where an individual can transfer £1,260 of their personal allowance to their spouse or civil partner. So this can actually reduce your tax liability by £252. HMRC allow you to backdate claims by to the 5th of April 2017. So it's great and certainly worthwhile to check if you meet those conditions. The married couples allowance. Now this allowance is much more tax efficient than marriage allowance, and this is aimed at older couples. This is a tax reducer and can actually save you income tax between £900 and £353. Certainly with this claim, it will need to be made to HMRC, and you can only claim either the marriage allowance or married couples allowance, so you can't claim both. And then finally, the blind person allowance, which is an additional allowance added on. If you are a higher rate taxpayer, you need to make certain that you don't lose your personal allowance. As previously mentioned, individuals are entitled to a personal allowance of £12,500. However, this is actually reduced, or rather it's tapered, if your income is above £100,000. And you will completely lose your personal allowance if it is above £125,000. If you're caught in this really awkward bracket between 100,000 and 125,000, your non-savings income is effectively taxed at 60%. So this is where tax planning can really help you mitigate this. We can first of all consider whether you can transfer assets between spouses and civil partners to make certain that you're using all the personal allowance available to you and the basic rate band. When transferring assets, you need to consider your capital gains tax position. And this is where we would say seeking professional advice is so important, just to make certain that the legal aspects are also covered as well as the tax implications. So obviously tax planning is really, really useful and very important. An effective tax planning method is considering using pension contributions. Anyone up to the age of 74 years old can actually pay pension contributions into a pension pot. And contributions can actually be made from starting from any amount that you want. Regardless of earnings, you can actually make a contribution of £3,600 as a great starting point. From a tax relief point of view, the maximum tax relief that you can get is 100% of your relevant earnings. Now, when I say relevant earnings, I mean your employment income, including benefits of your employment income, trading income, FHL income, and also patent income on any inventions. Now, there are two ways that you can get relief for pension contributions, this being relief at source or under a net pay arrangement, which I will now come to. So first of all, looking at relief at source. Now this is a way of making a private pension contribution, for example. Now this private pension contribution you will make at 80%. So in effect, the payment is grossed up by HMRC by 20%. So say you made a pension contribution of £800, HMRC will then add £200 on top of that, and then you get a total contribution of £1,000 in your pension pot. So it's really worthwhile and should really be made use of. The second part of the relief for private pension contribution is it actually extends your income tax band. So the gross payment that you make is added to your basic rate limit. So in the example that we've given above, your revised basic rate band will be 38,700. So you're getting more relief if you're a higher rate taxpayer. However, you do need to certainly be careful when you're making contributions, as you don't want to exceed your annual allowance limit. Now, currently the annual allowance for the tax year is 40,000. But this can actually be tapered for those who are additional rate taxpayers. Also, if you're drawing down on your pension, so certainly seek tax advice before you consider making large contributions. Also, your annual allowance is actually increased from any unused amount from the 3 previous tax years. So again, making certain that you get that tax advice and seeking financial advice as well is certainly of great use in this instance. In terms of net pay arrangements, this is where you're making employee pension contributions from your employment income, which is from your employer pension scheme. Now, contributions are actually deducted from your gross pay, and these contributions are deducted from the gross pay, and then the balance is then subject to PAYE. So you're getting tax relief at source in effect. However, just to be aware, and just to so you don't forget, but actually from an NIC point of view, NIC will be based on the gross pay and it won't be even considered if you have made a pension contributions. The minimum contribution that you can pay from your employment income is 5%, and this is statutory, so you can't change that amount. Then moving on to the employer pension contribution. This is a tax-free benefit, so make certain that you make the most of this. The minimum contribution that an employer can make is 3%, and this is not restricted by your net relevant earnings. However, there's an awareness point here that the contributions that your employer makes will be added to your employee contribution alongside any private pension contributions when assessing your annual allowance position. So make certain that you are within your annual allowance, including any brought forward from the 3 previous tax years. So in effect, by using the net pay arrangement, you can get 8% in your pension pot for 1 year. So definitely worth considering. Moving on to a different type of tax planning, there's charitable donations. The relief that you get is very similar to private pension contributions, as the payment you make is grossed up by HMRC by 20% again. So the donation you make, say for example, is £200, HMRC will add a further £50 on top of that, and the charity will receive £250. So absolute bonus for the charity. The second part of the relief for this is it actually extends your basic rate band. So if in this example again, we're going to be adding that £250 to your basic rate limit of £37,700. If you are making pension contributions, you need to make certain that you're actually paying enough tax for relief to be given by HMRC. If you aren't paying enough tax, HMRC will actually claw that tax back from you, and that will be by a self-assessment. So when you're thinking about a spouse or civil partners, if one of you has income below the personal allowance and the other one is a basic rate taxpayer or a higher rate taxpayer, make certain that you plan your contributions so that the higher rate taxpayer can obtain the relief for it instead of you having to pay the tax that HMRC has paid to the charity for you.
And actually, at this time with charities we know are struggling, don't we, Victoria, as a result of the pandemic. So anyone who is a taxpayer, if you do one of those things where you use your phone and send a message and they say, well, it doesn't even have to be like that, does it? But do you pay tax? Please do consider, it takes moments to fill in that extra information, and it's certainly worthwhile for the charities at the moment. And of course, from a taxpayer perspective, you're a higher rate taxpayer, you're getting relief at 40%, which again is very useful.
Absolutely. And then moving on to some tax efficient investments. So once you know your tax liability, there are certain investments that HMRC are encouraging you to invest in to get, first of all, income tax relief, and then secondly, capital gains tax relief on the investments that you're making. So starting off with some ISAs, these are in effect bank accounts. In the current year, you can contribute £20,000 tax-free, and any income that you generate or any capital disposals are completely tax-free. Now, there are different types of accounts available, and financial advice is required on those, I would suggest. And again, when we've discussed pensions, these grow tax-free and they are not included in your taxable income unless when you're starting to draw down on these. These are a great way of securing income for the future, and we really would recommend that you consider this for future planning. So moving on to some tax-efficient investments, which I briefly spoke about. There are different investment opportunities available, 3 of which I'm going to be discussing, and Diane will be able to add some corporate tax in there alongside that as well. The first one is EIS, so this is Enterprise Investment Scheme. Now, this is a tax reducer, and you will get 30% tax relief of the amount that you have subscribed in a company. Now, with this tax reducer, it can actually reduce your tax liability to nil if you've made quite a large subscription, investment rather. The maximum that you can actually get relief on is £1 million. This can reduce your liability to nil, but it can't create a repayment. And say it wasn't the best year to actually make the claim, well then we can actually consider carrying this back by 1 year as well. And if this investment is held for 3 years, then you won't get any withdrawal of relief. And should you make a gain on this sale, it will be exempt from CGT. From an SEIS point of view, this is a seed enterprise investment scheme. This is almost a smaller version of an EIS company, and it is seen as a tad more risky from an investment point of view. Subsequently, HMRC have made the relief for SEIS that little bit larger. So you will get 50% relief for the amount that you have subscribed, but this is restricted to a maximum of £100,000. So your maximum relief is going to be restricted to that. And similar to EIS, this can reduce your liability to nil, but it can't create a repayment. And furthermore, carrying it back a year is also a consideration. So provided you haven't exceeded the limits in the previous year, then certainly make the most of this. There are obviously conditions in order to obtain this relief, which we can help you with. If this asset is sold within 3 years, and yes, you make a profit on it, it will be exempt for CGT purposes. Now, moving on to VCTs, this is a venture capital trust. The tax relief that you get is 30%, which is similar to the EIS scheme, but this is restricted to a £200,000 maximum investment, so slightly differently there. The second difference with this one is that any dividends you receive from that VCT up to the 200,000 investment are actually tax-free. So if you know you're going to get the rewards via dividend, then certainly it's a great investment from that point of view. There is no carry back on this relief, so it will be based on if you've made the investment in that year, you can only utilise that income tax relief in that year. And again, it can't create a repayment. So you need to ensure that if you know you're going to be having potentially a large tax liability 1 year, then making that investment alongside that is great tax planning. With all these things, seeking professional financial advice is imperative to make certain that you're getting the most of the relief, and also that the companies are actually meeting the EIS, SEIS or the VCT criteria alongside this.
Yeah, and that meeting the criteria, certainly on the EIS and SEIS, that's something that you mentioned that we deal with. Certainly if you're thinking of making an investment, I think with both the EIS, SEIS and VCTs, come to that, they're all high risk investments. Seed and enterprise is, as it suggests, the name is the seed money that starts a company. So that applies to the first 3 years of a company's life. And they're definitely all, I wouldn't necessarily perhaps say that it's money you should be prepared to lose, but I think that's always kind of been my view on these investments. And certainly part of the application that we might make on the corporate side of things to the revenue is to point out to the revenue that this is a risky investment, because you have to demonstrate there is risk, otherwise that's why they're giving you relief. Also, I would say if you're thinking of making an investment, try to ensure that it's with a company that's seeking advance assurance first. Sometimes companies are so desperate to get their hands on your money that they take the money and give you the shares, and at that point they won't be able to apply for an advance assurance clearance from the revenue. But the advance assurance is certainly worthwhile, because at the very least, if your money's at risk, it would be nice to think that you're certainly going to get the tax reduction that you should do. And that's not something that when we make the application for the company, on the company's part, we can say that's a personal tax issue, but that's something as an investor that you should certainly try and ensure is in place, I think. So moving on to tax planning for the self-employed, just a few things to talk about here. Obviously, claim all your expenses. That means keeping your records, and it means being organised, which is sometimes very difficult, particularly in the early period of a business. But it is something that the revenue can ask to see. So do make sure that you record everything accurately. Capital allowances is one area where you can certainly make use of changing rates. The recent changes to capital allowances actually impacted largely companies, but I'll talk about that a bit more shortly. There was also some extension to the loss relief rules as a result of the COVID situation, and we'll come on to that. And because of all of that, changing your year end could be something that proves worthwhile. So on the capital allowances front, plant and machinery expenditure is basically what qualifies, but also cars. There are various different categories of expenditure that may well qualify. The standard writing down allowance hasn't changed. It's 18% for the main rate and 6% for special rate assets. And those include integral features. So that's things that are integral to a building, like the light and heat, and some slightly more obscure things to do with solar shading. But those are the sort of things that go in the 6% pool, as well as cars which have now emissions more than 50 grams per kilometre. Until April this year it was 110, so the goalposts have been moved somewhat on the car front. Also long life assets, although to be honest, I think I've seen that once in my entire career, or some considerable years, so they're not something which comes up very often, but they're assets that have a proven life of at least 25 years. So writing down allowances should be available on everything, and investment allowances on slightly fewer things, and also no annual investment allowance for trusts and mixed partnerships. So that's a partnership which has got a company as a partner. Cars, you'll only get an annual investment allowance, or rather the equivalent of by 100% allowance, if you are buying a particularly efficient zero emissions car, and there are an increasing number of those. But when the government first introduced some of this legislation, I think at the time we knew it was going to make no difference at all, because there are about 2 cars on the list. But the goalposts keep moving, because all the companies are trying to invent cars which have much better battery life and so on. So some cars will get almost 200 miles on just the battery now, which is clearly improving the position, and the price of the cars will come down. So obviously we'll see a lot more investment in that area. When the annual investment allowance was extended to £1 million from, that was temporarily introduced from January 19 up until the 31st of December 2020. That's been maintained for 2021 as a result of the pandemic. That means that there will be some hideous transitional rules that we all have to grapple with when it comes to dealing with 2022 and year ends that are not coterminous with the period for the capital allowances. But hey, that's what we have accountants for, I guess. They are ugly rules, I must say. There's something else to be careful of here, is that if there's more than one business or trade, there's some anti-avoidance legislation so that you can't fragment your business and take advantage of the annual investment allowance on repeat. So it will get divided up if there's more than one business under common ownership. As far as loss relief is concerned, there have always been a myriad of choices of the way to use losses as an individual. You can set it against other income and capital gains, or against same trade, or in fact against the profits of a company if you transfer your trade into the company. However, there's been some updating of the loss relief rules, again as a result of COVID, because businesses are clearly under stress. And these rules apply for 2021 and 21-22. So 21-22 means the tax year ending 5th April 2022. In those 2 years, trade losses that arise can be carried back and set against profits of the same trade for 3 years before the tax year of the loss. So that all the old rules will apply anyway, and the effect probably is going to be that you get the second and third years going backwards as additionally available for loss relief. So that does mean that in a loss in the year 2021 can actually go back to 2017-18 potentially, although the overall limit for this particular loss is £2 million, so that, it's a fairly substantial loss for an unincorporated business. So if we look at an example, an individual with losses as set out on this slide from 17-18 up to 2021, well, they had a profit in every year until 2021. They had a huge loss of £3 million. They've also got, frankly, where they find the time, I've no idea, but anyway, employment income of £50,000. So how do they use these new rules to their advantage? So we're looking at 2021 and backwards, as it were, now, remembering there's this £2 million cap. And where you can see the advantage of these additional loss relief rules is back in years 18-19 and 17-18, because we're able to use £50,000 against the employment income of our original £3 million in the current year, or when I say current year, I mean the year that we're doing tax returns for, I guess. In 2019-20, again, we use £50,000 against employment income, and we can set another 500,000 against profits from self-employment. That's under the normal rules. We can then elect to carry back another £2 million worth of losses into those 2 earliest years. And you can see the tax relief, tax saving that gives us in each of those years. And then the adjusted income column shows that at the end of all of that, we have another £400,000 loss to account for in 2021-22. Obviously, depending on how the results of that business turned out in that year, there may be a further loss, but there will still be some opportunity to carry back. Well, we seem to have exhausted all the profits, so so we won't be able to use any more of that, I think, because 17-18 will then go out of scope. As far as national insurance is concerned, there's a little footnote on this slide, and it's something that's often overlooked, because where you're relieving losses against profits, if you are relieving trading losses against other income, that other income won't have borne class 4 national insurance. So if you don't set the loss against trading income, you won't be getting the relief for national insurance. So actually you may have a greater loss to carry forward for national insurance purposes than you will have had for income tax. The other key planning point, a result of the changes, is that at the moment it may pay you to change your year end. Why would you want to do that? Well, by using up your overlap relief, and usually overlap relief is something which occurs when a trade ceases. So overlap relief begins when a business originally starts trading. There'll be, the way the basis periods work is that there will be a period which overlaps, and you effectively pay tax twice at the very beginning of the business in that overlap period, and that sits there waiting to be relieved until a later date. You can generate relief from that early if you change your year end, so hence the benefit of the cash flow. When you change your year end, you have to make sure that your basis period is not less than 12 months, because that won't work basically, and there will always be a period when the income will be taxed. So there's not like anything is going to escape income. The thing to think about when you're planning a change of accounting year end is also not just that you can claim this additional loss relief perhaps, but you also have to bear in mind that on the other side, marginal tax rates may be higher in a later year. So it may help you now, but it may be a cost later, and that's always something to take advice on. The basic rules for changing your year end are that the new year or new period, mustn't exceed 18 months. You have to inform the revenue of the change by the 31st of January following the year of change, so in other words, by the tax return deadline. And if there has been another change in the previous 5 years, it has to be demonstrably for a commercial reason, otherwise you won't be able to change your year end again. And if you breach any of those conditions, the revenue will ignore the change. Okay, oops. I linked on something there. Okay, back to Victoria now, who'll talk to you about capital gains tax and a few planning opportunities in that area.
Thank you. So CGT, this is the tax that is payable when you dispose of an asset. Now, when I say dispose, I mean you sell it, gift it, swap it for something else, or even compensation for if it's lost, an asset is lost or damages. In the following slides, I'm going to talk to you about, more specifically, about residential sales, and then Diane will come in with business asset disposal relief, which is applicable for those in business. So starting off with the rates of CGT, all individuals are entitled to an alley exemption on gains made of £12,300. So if you make a gain of less than this, then capital gains tax will not be payable. Gains arising above the annual exemption will be subject to CGT depending on the type of asset that you're selling. If this is a sale of residential property and the gain falls within your basic rate band, then this will be taxable at 18%. Anything above the basic rate band will be at 28%. And then any other chargeable assets, for example, shares or securities, will be subject to 10% in the basic rate band or 20% in the higher rate band. Focusing specifically on residential gains, HMRC brought in the rules in respect of sales of UK residential property, whereby from the 5th of April 20, if a disposal of UK residential property occurred and CGT was payable, then a CGT return and that liability is due 30 days from the date of completion. And this has caught many people out. Also, if you are a non-resident UK, non-UK resident, and you've sold or disposed of any UK land or property, a CGT return is actually due regardless of whether any tax is actually payable. We have to be incredibly careful with these rules because HMRC are quite happy to issue penalties and interest on any unpaid tax. So it's best to make certain that everyone is aware of this. Moving on to the residential gains reliefs, the main relief to consider when a sale of property has occurred is private residence relief. Now this exempts the period you use the property as your home. And this is the period where you've lived in the property and also the last 9 months. If you haven't lived in the property for the entire period, there are also some other deemed occupation rules that allow you to claim relief for those periods you weren't actually living in the property. These being where you were employed abroad, or if for up to 4 years when you're working away from home, and this does include self-employment. And then finally, 3 years for absolutely any reason at all. And in order to claim these deeming rules, though, you have to make certain that you live in the property first and then return after that period. And those periods can apply cumulatively, so you can maximise your relief. However, making certain before and after is actual occupation.
And those rules on main residence also apply to properties abroad, don't they, Victoria?
Absolutely, yeah.
I mean, we increasingly have a lot of international clients, and quite often they've had properties abroad and then move over here, and so those rules would still apply, don't they?
Definitely. And making certain that if you've got more than one property, you make that election to HMRC to confirm which is your main residence, as you don't want there to be, and don't want HMRC to be able to question it or even have to make the choice or decision for you. Now, moving on to lettings relief. Now, this actually changed from April 2020, and HMRC have effectively made it harder for you to claim lettings relief. Lettings relief now is available if the property was your main residence, and then part of the dwelling was actually let whilst you were using this property as your main home. So again, made it much harder to claim that relief. And all claims will need to be made, first of all, through your CGT return, and then secondly, on your self-assessment return. From a tax planning point of view, It's really good to consider making the most of your spouse's or civil partner's annual exemption. This is tax planning. This is not evasion on that sort of scale. It's certainly worth getting legal advice and tax advice to ensure that you are covering all CGT and also some stamp duty and SDLT areas. Now, passing over to Diane to talk about business asset disposal relief.
Okay, so business asset disposal relief, a lot more of you will be familiar with the term entrepreneurs relief. I don't know why they changed the name to something that's much harder to say and has 4 initials instead of 2, because the rules didn't change, although there were some changes in the rules before the name changed. Those changes were more to do with the entitlement to do with shares, if you're selling shares in the company, but the basic rules didn't really change at all. So the 10% rate is what everyone sees as the kind of aim whenever we're doing any tax planning. If we can get to a tax, obviously nil tax is the best answer, but 10% is usually seen as a pretty acceptable alternative. And the limit for lifetime now is £1 million. It was at 1.10 million, but it got reduced a few years ago. Again, this is something you report on your tax return. There isn't any real-time reporting on the business on assets that are subject to business asset disposal relief. Qualifying disposals are going to be sale of part of your business, so that means a sole trade or a partnership, or it might be that you hold shares of securities as a result of being an employee or an office holder in a trading company, and in that case you need to hold at least 5% of the shares. The rules on enterprise management incentive schemes are particularly generous around business asset disposal relief, and so that 5% rule, which is normal for everything else, doesn't apply, and the shares don't have to be owned for at least 24 months, which is again the standard. For an EMI scheme, they simply have to be options that have been granted within for that period, so that's quite helpful if you happen to hold those kind of shares. Again, there's a one note of caution, because if you have, say, a partnership and you've owned the partnership premises privately and the business has used them, you may well have needed to charge rent because you had a mortgage in your own name. If that's the case, then that would have been the main driver for deciding about the rent to be paid. But if you have an option over it, you need to be careful that you consider whether the rent bird in a hand now is better than the loss of business asset disposal relief if you make an associated disposal when you sell the rest of your business at some point in time. And I guess it depends on how imminent that sale of the business is compared to how important it is to receive rent at the point that you make that decision. So business asset disposal relief affects, lots of businesses will be entitled to relief from this. So on this example, we've got factory premises, some goodwill, and there's a retail shop as well that this person owns. The total of those is £450,000 net. The annual exemption apparently for this individual is still available. And so when we come to calculate the capital gains tax liability, we can deduct the £12,300 from the £450,000 of net gains, and tax of only £43,770 is due. 10% on the proportion of that amount of gain, provided the proceeds are all received immediately, should be eminently payable. And that leaves a further 562,000 odd that you can use in the event of a sale of a subsequent business. So a few more topical areas just to think about. One in particular where we're seeing quite a lot of activity, we know across the tax assist offices and also within the consulting team, there has been a targeted campaign by the Revenue in relation to offshore income and gains. There have been a number of these. It started with Liechtenstein, which is known to be a tax haven, and obviously links to Europe have helped to discover information in relation to that country. The net of the government and interlinking with all the other governments signing up to the same agreement has extended, which means they can pursue these kind of offshore income and gains more vigorously. So we then had a requirement to correct, and if you didn't use that facility by the 30th of September 2018, i.e. you failed to notify and disclose by that date, you're now into the current regime, and the penalties under this latest regime are a lot stiffer. So you basically come under the failure to correct penalty regime, which means that the revenue regard as standard 150% penalty and quite often 200%. And bearing in mind that some of the tax here can be quite significant, then obviously paying the tax is, that's a fair cop. If you didn't pay tax on the income and gains that you should have done in the first place, but then paying it all over again once is bad enough. To pay it once and a half or even twice, we're looking at quite a lot of some sizable penalties here. We had a case quite recently where an individual had relatively minor income, and so the tax and penalties wasn't overly onerous. But then there was also, and I mentioned the main residence rules applying in this kind of instance, there's also a property in a foreign jurisdiction that was sold. Thankfully, he was able to take advantage of some reliefs that applied because he'd owned this property way back in the 80s, and there was a particular relief that applied there. But as a result of claiming that, we saved £76,000 of tax, and paying that twice more, as you can understand, is quite significant. So it is something to be very careful about. We're not really seeing any unprompted disclosure in this area now. It's all as a result of letters from the revenue. They send out what they call nudge letters. They're not an official inquiry as such, unless they specifically say so, and they will include a certificate of tax position that they invite you to sign. We've seen this particularly, countries to mention at this point, with regard to Italy, India and Ireland. So we're obviously working through the alphabet. I don't know what comes after I, but anyway. So the certificate gives you 3 options, but those options may well not apply to your situation. So I need to bring my tax affairs up to date. I don't have offshore income and gains. My tax affairs don't need updating. And each of those is quite dangerous to sign if you're not absolutely sure that you're the right side of any of those. And as a result, the Chartered Institute of Tax doesn't recommend signing this. That's their guidance, and we follow their guidance. So we certainly don't recommend signing that certificate. On receiving these nudge letter from the revenue, we suggest instead sending a letter of your intention to notify that a disclosure will be made in due course, and then a period will be given and you'll have a deadline to work to. It's important to be really clear, what the position is, and you have to respond to the revenues letter whether or not you fancy signing the certificate. As I say, we don't recommend that. It's actually anticipated that 1 in 10 people in the UK have some sort of offshore financial interest, which is quite a staggering statistic, although we are a multicultural population nowadays, and some of these are historical, where people have moved to the UK, they've had property and investments in other jurisdictions, but equally people are investing offshore increasingly. So the common areas are income or gains from property or a pension, which is situated outside the UK, the incorrect use of the remittance basis rules, which apply to non-domiciled individuals, and considerations around offshore trusts, which includes the 10-year inheritance tax charge. If we deal with one of these matters with you, it's really important that we ask you the right questions and that you equally are fulsome in your responses, because, as I mentioned, the penalty regime is scary, frankly. And don't underestimate the revenue on this. They have really got the bit between their teeth. They have a lot of sanctions available to them, and they are showing no mercy at the moment. So that's something to very much be aware of. Right, back to you, Victoria.
So moving on to tax on landlords, obviously HMRC have had the Let Property campaign, which is in full swing, and lots of landlords have actually used this to declare their income arising in earlier years. Just to cover off the whole topic, rental income does need to be declared on your self-assessment tax return, and it will need to be declared if it's above £1,000. You can use the HMRC online checker to confirm whether you need to do a tax return, which I would advise you to do. The property allowance is available to all. It's at £1,000 deduction, which can be used instead of actually deducting actual expenditure. Alternatively, obviously, you can assess your income, or rather your profit, deducting any actual expenditure that you incur. However, you must keep records of this. This needs to be kept for about 6 years, as HMRC can inquire and go back that far. if you actually don't end up keeping all these records and HMRC do inquire, they can actually deduct and change your tax return without you actually having the supporting documentation. So it's certainly worth keeping them. Any profit that you actually make from your rental property will be subject to income tax at 20%, 40%, or 45%, which then makes you think, actually, if you've got spouse or civil partner, tax planning is really useful in this area. If you jointly own property, the income needs to be declared 50-50 regardless of the actual legal ownership. So in this instance, if you have a high rate taxpayer and your spouse has income less than your personal allowance, it's really worth considering, actually, can we change this income sharing ratio? So in this instance, we could say, consider doing a Form 17 and a declaration of trust to declare that the beneficial interest in that property is different. So in effect, you could change it from 50-50 to say 90-10, making the most of the personal allowance and the basic rate band. You must make certain that if you're doing this, you do seek legal advice to make certain that the paperwork is all in place, and then subsequently doing the Form 17 and submitting this to HMRC to clarify that this has actually happened. On a side note, you need to watch out for any stamp duty land tax charges that may apply. Now, even if no consideration has changed hands, if there's a mortgage balance on this transfer, then this will have an SDLT implication. So it's very, very much, and it's very important to get that legal advice before doing anything. From an awareness point of view from Class 2, if your profits are more than £6,500 a year and you're running this rental as a business, then you will be subject to Class 2 NIC. Now, if you're classified as running a business, for example, that would be this being a landlord is your main job, or if you rent out more than one property, or even if you're buying more properties to rent out to create a business.
I think it's worth saying, though, isn't it, Victoria, that the idea of running a business doesn't sit very nicely next to what is generally an investment activity, and the revenue are looking for a lot of effort on the part of the person running the business in order for you to fall into the business as more of a trade than to be just an investment activity. So I think it's important to be a bit cautious about that. There has been case law, and that's something we can advise on if people are not sure, but it does really mean quite a lot of effort has to go into that business, and that all the appearances that it's being run as a trade.
Certainly, and if you're not paying Class 1 NIC, Class 2 NIC is a great way of obtaining a qualifying year for state pension purposes. Alternatively, you have got Class 3 NIC to consider there. Moving on to sort of restructuring, which is certainly Diane.
Yeah, okay, so our final bit of technical stuff here is the idea of perhaps restructuring your property portfolio. This is something we've looked at for a great many clients now. It may be that owning property in your own name is not the best structure. There are other alternatives, basically a company or a limited liability partnership. Those are the two most common ways. But moving from one to the other, and that's usually the planning piece that we get involved with, does inevitably involve some costs. So if you can structure it the right way from the outset, that's always preferable. If you're unincorporated at the moment, it's important to be aware of things like potential ATED charges if property goes into a company, capital gains tax if you've owned the property for a while. If it's been partly used as a main residence, then that can be a helpful factor, because that will mean the gain is reduced putting it into the company. And inevitably SDLT, again, the one that always crops up with properties. So if holding a property within a company, for instance, means there's no restriction on interest relief, which has been a problem for individuals since the rules were tightened recently. On the other hand, the interest may be allowed, but the mortgage itself may be more expensive, not too much more. And at one time, lenders seem to be very reluctant to lend to new companies. Strangely, they seem to have changed that completely now, and a special purpose vehicle seems to be their preferred option, but it can mean the mortgage is a bit more expensive. the big advantage for having it in a structure other than individual ownership, or indeed a limited liability partnership, because, and I'll just pause there, a limited liability partnership, whilst it has limited liability like a company, the individuals are taxed just like individuals outside of any kind of business arrangement. So there's no advantage for tax at that point. But if you put property into a company and you know that you're going to need to borrow relatively heavily, the thing to consider is how much is it going to cost you to repay that debt from a company as opposed to an individual perspective. If you own property and you are an additional rate taxpayer at 40%, or even a higher rate taxpayer at 40%, sorry, did I say that right? 45 or 45%, anyway, those are the rates I'm talking about, versus the current corporation tax rate of 19% in a company. In a company, you get to keep 81% of your income, whereas individually, you're only keeping 60 or 55%. So therefore, you're having to pay a lot more after tax income out to repay debt in an individual position versus a corporate position. So that can be, that can significantly outweigh a slight increase in the rate of interest. Also, it's important if you're planning on passing shares, and it could be literally shares in a company, if you're planning on passing assets out to family members, sometimes that can be easier through a structure rather than just as an individual. So all points to be aware of. So I think we've come to the end of our formal slides. If anyone has any questions with anything that we can answer, we have got a couple of questions. So can everyone see these questions on the screen? Okay, so I'll read out the first question. Do we help setting up smart company structures in terms of capital gains tax, dividend income and inheritance tax? Yes, I'm sure that we do, is the answer to that one, I think. Business asset disposal relief, is it restricted to company trading type? Well, the key thing for BADR, let's say that's slightly shorter, is that it is related to trading activity. So there must be a trade. And I was mentioning earlier, just thinking about class 2 for individuals and property. So property businesses, generally speaking, are going to be an investment rather than a trading activity. And that's true whether it's in a company or whether it's in individuals. So BADR is almost certainly not going to be available unless, again, there is this very high level of activity. Furnished holiday lettings, slightly different position for individuals and for companies. And if you're doing property development work, then that's clearly a trade, but it is certainly the case. So good question in that sense that BADR is related to trading rather than an investment activity. Okay. If anyone has any other questions, we can certainly deal with that as a separate matter. Someone has said, why didn't we talk about inheritance tax today? Well, this was basically about income tax and capital gains tax, as opposed to, as I think inheritance tax is such a different area that we would always cover that under a separate presentation, and that's certainly something we can think about doing in the future.
Absolutely.
Yeah. Right, if there are no more questions, then I think we'll close for now. As I say, if you think of anything after the event, then do please email us and we'll try and respond as soon as we can. Many thanks for your time today and enjoy the rest of your day.